Having looked at as to how we arrive at the financial statements, namely the balance sheet and the profit and loss account, we will move on to see some of the components of these statements. We start off with fixed assets. The scope of our discussion would be sort of to look at fixed assets and understand what capital and revenue means in terms of income and expenditure. We will also look at how to arrive at the cost of fixed assets. We will see the concept of depreciation, the methods of depreciation and how the accounting entries for depreciations are passed. We will also look at what happens when you sell a fixed asset and how fixed asset, given the depreciation, is represented or presented on the balance sheet. This is what broadly we will look at and try to understand each component. Now, before I move on, let's look at the fixed assets part through a video to get a sense of how we look at fixed assets.
When we talk about fixed asset, it is an asset which has a long life, so it's long-lived resource. Business use such asset in the production of goods or services. And such asset provide benefits to the business for the period longer than 1 year. So this asset is not consumed in the activities of the business during a year. And such asset, it has limited useful life. So that period during which the asset provide benefits to the business is called useful life. And the question is why this useful life is limited. And the reasons might be different. First of all, of course, the asset wears and tears. So this is a decline in value of the asset when it is used in the activities of the business. The other reason, it can be obsolescence. The asset can be new, however, not economically efficient, or due to technological changes, it cannot be used anymore in the activities of the business. And also limited life. Some assets have just limited life.
So fixed assets are a long-term physical or a tangible asset. That is something that you can feel. We will stick in our discussion here to the long-term physical assets and not the so-called intangible assets, such as say a license that you have which can give you a benefit in the future, or a patent that you have which can give a benefit in the future. So we will focus on long-term tangible assets, and these assets are not held for sale. That means these are not like products or goods that you are buying and then selling. So the distinction is that when you have products or goods that you are going to sell, then that is not your long-term asset and that's not your fixed asset. A fixed asset should be such that it provides a future benefit, a future stream of benefit or revenues. So the cost of these assets, now what happens is, logically, if I were to buy a product that I am going to sell, I will cost the product and then sell it and remove the cost to arrive at my profit. But here we have bought an asset which has a long-term benefit attached to it. So therefore, the amount I spend on such an asset, I should not, given the matching principle, we should not expense it against the income or to the profit and loss in the year it is purchased or the accounting period it is purchased. The cost should be spread over or expensed over the useful life, the estimated useful life of the asset. This spreading is also called as depreciation, as we briefly saw before, and we will look at a greater detail. So essentially, fixed assets or long-term assets are of the nature where there are future benefits that will come. There is a certain useful life to this future benefit, and the cost of such an asset is not expensed in this year or the accounting period that it is bought, but it is spread over the useful life. This is the concept we have to remember as far as fixed asset or distinguishing fixed assets from other assets. So now, as I said, we will look at the distinction between capital and revenue, which can be capital expenditure and revenue expenditure, as well as capital income and revenue income. So first we look at what is capital expenditure. Capital expenditure, as I just now explained to you, are those kind of expenditure which are not expensed or which are not written off against the income in the year it is incurred. We do not charge it against the income in the year it is incurred. So typically the long term fixed assets that we buy are are in the nature of capital expenditure, because these long term fixed assets, you don't charge off the expense or that expenditure in the year it is incurred or the accounting period it is incurred, but you do it over its useful life. So such expenditure when a business incurs is called as a capital expenditure. Obviously some of you might be thinking, what is the need to do this kind of distinction? We will see that a little later. Then we look at what is as revenue expenditure. Obviously revenue expenditure, given we have understood what capital expenditure is, the kind of expenses that you incur to run your business. For example, when you purchase raw material, when you go and distribute your products to your customers, the expenses incurred in selling it, the interest expense for buying your products or buying your raw material, you must have borrowed some money from the bank, you are paying interest on that expense. So those kind of expenses which are for running your trade, running your selling of your products, is known as revenue expenditure. But when you incur certain amount of expenditure on your fixed assets for to maintain them, for example, when you enter into a annual maintenance contract with the manufacturer of a particular machinery. Now that is to ensure whatever productivity that machinery should give, that productivity or the earning capacity is maintained. Now such expenditures are also called as revenue expenditure. But if you add something to your machinery, for example, your machinery was producing 1,000 units a day. Now you have done some changes, you have spent some money on it and added something to it, by which now it is going to produce 1,200 units per day, that you have enhanced its capacity. So when you do such an expenditure where the machines or the assets capacity is increased, then that is a capital expenditure. Otherwise, where you are just maintaining its capacity, trying to maintain the machine's output, then that is termed as revenue expenditure. So let's move on to what are the capital income and revenue income. Capital income basically comes out of sale of fixed assets, long term assets that you have in your business. When you sell them, there may be a gain or a loss vis-a-vis what we call as the book value, which we will see shortly, and that income from sale of such disposal of such fixed assets, long term assets, is called as capital income. And revenue income is actually the income that you get out of a core business, which is selling your products and services. So that is the income that is called as revenue income. And obviously if you are generating sufficient surpluses, your profits are so high that you have sufficient surplus cash which you are depositing in banks or such other instruments, then the interest or the returns generated there are also part of your revenue income. At this time, I should caution you on one thing, as to not to confuse them with what are known as capital transactions. Now, what are these capital transactions? For example, if the owners bring in equity, now we call that as capital being brought in. Now we should not confuse that with the capital income or expenditure. That is essentially a liability that business has incurred towards the owners, and the entry is that the cash that the owners bring in goes to the bank, so you debit bank, asset goes up, and credit capital, or in case you have taken a loan, you credit loan. So that is the kind of, so when a loan comes in or a capital is brought in, then that is a capital transaction, that has nothing to do with a capital income per se. I hope this clarifies if there was any confusion on that front.